the inside bar breakout trading strategy. This is something a little bit new. It's a twist on the standard breakout strategy using inside bars. And if you don't know what an inside bar is, it's a pretty common candlestick pattern. You're going to see it on any time frame. So essentially what happens is an inside bar forms when the high and the low of that bar are contained inside the previous bar called the mother bar. And when you see an inside bar, what you do now know is that on a lower time frame, you have a consolidation of price. Now this is a 65-minute stock chart. And to set this up, I actually use the daily time frame first. So number one, on the daily time frame, this would be the mother bar. And inside of that, you can see there are numerous days trading. At number two, this is actually the first inside candle on the daily chart. I just broke it down here on the 65-minute chart so you can see it. At number three, this is actually the second full day where the number one, the mother bar, still has price contained inside of its range. And number four, this is another day that's contained inside that mother bar, number one. So what you're looking at here is an inside bar. We can actually see the high of number one is acting as a resistance level and the low is acting as a support level. So each day, price does break the previous day's support or resistance of that particular inside candle. And by this example, you can see that trading inside of a mother bar can make for some pretty choppy trading action. So let's talk about the characteristics of it, okay? Because they're not worth trading on every single time frame because they are pretty common. Now, most candlestick formations oftentimes are better to trade on the higher time frames, like your daily chart or your weekly chart. And there's a lot of price movements on lower time frames that you can actually get stuck in, especially when you get periods of low volatility. And that actually can make price action that is tough to sit through when you're in a position. Higher time frames are also able to absorb any economic releases without having a lot of whipsaw price action. The second thing to consider is the inside bar size, because it does kind of matter when you're comparing it to the mother bar. And for the strategy that we're going to talk about, we would like to see the inside bar significantly smaller than the mother bar. But I will say it is not a strict requirement. And I want you to notice the inside bar on the left is much smaller than the mother bar when we consider the distance between the lows and the highs. So this shows that the smaller time frame consolidation is tight, less price range. On the right, what that shows is an inside bar, the highs and the lows close to the extremes of the mother bar. And this shows there is more price movement inside of the mother bar. So the range on the inside bar is bigger. With inside bars, we prefer to take advantage of tighter price compression with the theory that it's going to lead to bigger price moves. Also consider that with this rule, where price actually closes on the candle. For example, on the right, price closed near the bottom of the mother bar and in the inside candle. So if we're looking for longs, taking into account the obvious bearish traders, this would actually be a strong buy setup. Also, smaller inside bars are going to have a greater distance to travel to the higher low of the mother bar. And what this will allow is better trade management before price reacts at the potential support or resistance of the mother bar. Trend direction, counter trend trading is pretty popular. However, when you can latch onto a trend, that generally makes for a less stressful time when you're in a trade. But let's be honest, is trend direction a guarantee of success? Absolutely not. In fact, you could actually be the buyer in an uptrend at the exact top of the instrument that you're trading. But using trend direction as a variable in your trading plan can actually reduce your temptation to take every single trade. So for my money, riding the trend with an explosion from an inside bar breakout is a better risk. So now we talked about the characteristics. Let's cover the typical breakout strategy that's used. Now the black horizontal lines, that indicates the high or the low of the inside bar that broke first, so which direction. So you can see that some gave enough price movement to manage your trades and others didn't. They were stopped out quicker. So if you narrow that setup down to the trend direction of down, your outcome is actually pretty good in this example. So let's just circle right back to what an inside bar represents. It represents a consolidation on a lower time frame. okay, a trading range. So is there a way to take advantage of that truth? Yes. False breaks of that range. So really, there's nothing better than seeing traders stuck in a position and they have to get out. So requiring a breakout of that inside bar in the opposite direction to the trend is something to consider. So I use a trend line here to show that the uptrend was in danger on the left when price broke to the downside. We see an inside bar setup, right? It's a lower time frame range. Keep that in mind. The next candle, we actually see a breakout of the high of the inside candle. What does that mean? Buyers entered the market in hopes of catching a new impulse move up. What actually happened? Price reversed. It trapped the buyers who now need to exit. And once price breaks the low of that false breakout candle and then the inside bar candle low, buyers are just jumping out of their positions. So if you're short, you're actually getting a really nice push down in your price. So with that, let's make some trading rules. Okay, so the first thing that we have to do is determine a trend direction. We can use trend lines. We can use price structure. We can use a 20-period moving average. Okay, then we would look to trade in that direction. So if we're looking for a buy, we want to see price break to the downside of the inside bar first. If you're going short, we want to see the high of the inside candle broken. Look at this chart here. This trend is up on this daily stock chart. We first see an inside bar on the left side of the chart. Okay, at the close the next day, price had made an outside bar. That invalidates the setup. So our other labeled inside bar forms. Price breaks to the downside of the inside bar, getting traders into a short trade. We can then place a buy order over that candle or over the inside bar candle's high. Okay, I prefer the candle that happens after the inside bar. The stop loss will go below the bar that broke the inside candle to the downside. Price then forces the shorts to exit their positions while you are taking advantage of that strong move up in price. Let's look at another one. The trend is up, looking for longs. Inside bar sets up, price breaks lower, buy stop the high of the candle for an entry signal completion. We get another inside bar formation, price breaks lower, buy stop the high, off to the races. Stop losses. If you set a buy stop order to get into the trade, you have to know where you're going to exit if the trade goes against you, because without that, it's very difficult to set any sort of risk, right? So you can use the low of the candle that breaks the low of the inside bar, or use half of the range of that candle. Once your trade is triggered, you can then adjust your stop to the low of the trigger candle. I'd wait till that big candle would close, actually. Now, keep in mind that these charts, these are chosen to explain the strategy, okay? They're not all going to work out. The long setup was fine, okay? We even see a hint of a bullish move on that second bar. Trade triggered, next day gap down 8% from the inside bar break. That's why risk management is vital. And this chart brings up an important consideration: strong close. Because we expect follow through on these trades given the reason why they're setting up. So traders may want to consider seeing a strong close potential near the end of the day. So the day after the breakout, price essentially pushed higher for 1 hour and then settled back to the high of the trigger candle. That's what happened there. That's not a sign of bullish intent. And while you may exit only to see price continue in a strong trend direction, risk should always be the number one priority of any trader. So what do we have so far? We have trading the direction of the trend. We have looking for an inside bar. We have a look for a breakout of the inside bar in the opposite direction of the trend. Set a buy stop order above or a sell stop below the breakout candlestick or the inside bar. Set a stop loss 50% through the range of the breakout candlestick on the trade trigger. Now, there are a few other things that we might want to consider to give us some trading opportunities, and that's confirmation. Now, before I talk about that, just know that the more variables that you add to a trading strategy, the less trades you're going to get. So you really have to consider each addition to the strategy. The question should always be that you ask, does this make a big difference to my results? Okay, so here, this is a reversal trading setup from a failed breakout of a trading range. So can we add something that has the potential of having more traders leaning in one direction? Yes, and that is the first candle type, so the mother bar. So I want you to notice that the mother bar, to the left of the inside candle, it's red. So this tells us that market participants were biased short on that day in an overall uptrend. So the color of the inside bar, I don't really concern myself with that. But the main focus, we want to know that traders are short. Okay, we can see it. So the day after the inside bar breaks the downside, the next day, price moves up through the trigger. So the key would be to have the mother bar candle a color opposite to the overall trend direction. If the trend is up, which would be green, we want the candle to be red. So in this case, price action was to the upside. Just by looking at the moving average, we can see that, right? So we would look for a red mother bar. Taking profits, that and trade management can be based off the structure of your price. You could also consider using a trailing stop. Let's just discuss price structure targets. So in this example, the bar before the inside bar is red. It's the context of an uptrend. Price breaks the low of the inside bar. We buy stop the high of that candle. Once triggered, we now have potential resistance at the high of that inside bar and at the high of the mother bar. So we can consider profit targets or trade management at those areas. Now, some traders are just more aggressive, okay, and they may want to add an adjustment to the strategy. And I will say this, I highly suggest that you only do this once you prove to yourself that you can follow all of the trading plan rules. Okay, in fact, some traders may want to use this method for intraday trading, right? Quick profit targets, quick stop outs, that's vital to this approach. So instead of looking for a trending market, we're just going to look to see where price is trading in relation to the opening price of the instrument on that day. So in this example, this is a 5-minute trading chart. The black line is the opening price for that day. So as long as price is trading above it, we're not going to consider short trades. Long trades are noted with the arrow on the chart. Okay, that's the only one that's allowed. Here's another example. The horizontal line is opening price. The black arrows show the inside bar. We get a break below the inside bar. We look for long trades only. Now, I covered a lot of information here. I wanted to give you a few tools to help you design your own strategy. So the key point to remember when you're doing that is we're looking to catch traders on the opposite side of the real move. This is why we require a break for longs through the lows of the inside bar first. We then want to catch that move back through the inside bar range. Now remember, inside bars, they appear why? It's a period of consolidation on lower time frames. So essentially what we're looking at is breakout plays after other traders take the wrong position. My final tip is ensure that you read out your trading plan, follow it consistently. We covered a lot here. If you have any questions or comments, put them below and I'll get to them. Make sure you like and subscribe to our channel. Thanks for watching.